Welcome back to our special show, Nomura's View of India. I have with me the brains trust of Nomura India. I have with me Sonal Verma, the chief economist, Prabhat Abassi, the head of equities, and the head of fixed income, Neeraj Gambhir. Before I get to the stock picks, Sonal, what are you working by way of Reserve Bank action?
Well, I think, Reserve Bank, yes, surprised saying they would watch data, and data essentially is suggesting that they will cut because, the November CPI reading also showed core inflation numbers coming down. Services is contracted a lot more. Rural consumption indicators have fallen quite sharply. So our assessment is post the budget, they will, deliver a 25 basis point rate cut. Beyond that, some of the fundamental drivers of inflation we feel are stabilizing. So, rural wages are... One cut is what we are looking at. Given our view that underlying inflation is going to be around 5%, we have the RBI staying on hold.
But you think that even if it is 125 basis from the Reserve Bank, Neeraj, the banking system can reduce the cost of money a goodish bit?
So I think the fact that we are now in a hugely liquidity surplus environment, and I think for a long time the banks were complaining that the liquidity is deficit and they have to borrow from Reserve Bank. Now we are in a situation where liquidity is amply surplus, and it's getting sucked out through the repos and MSSs. So banks have a lot of opportunity to now cut the rates on the liability side. There is no need to chase the deposits as probably they were doing in the past. So there is a possibility that they can actually take that pressure off the liability side of the balance sheet and say that let's just do a little lower in terms of deposit rates, and that can be passed off. The more important thing is that there is lack of credit assets in the system. I mean, with this kind of liquidity very deployed, so I feel that the banking system will have to come back to the bond market and say that where can I put this money in.
So what is the 10-year yield itself? 6.4, it has moved away from 6.1. Does it get to 6?
Well, it could get closer to 6.25, but the real, I think the real action is going to be 10-year bond, government bond. I think it's a lot more in the front end of the curve. It's a lot more in corporate bond space, where if you look at 2-year and 3-year corporate bonds, they're currently trading at about 100 basis points spread over the government bonds. There's going to be a lot more in state development loans, where the spread is about 60 or 70 basis points. So money will come into those kind of assets where the spreads are reasonably high, and there is going to be some kind of a chase in those assets from both mutual funds as well as from the banking system, right?
Okay. All right, Prabhat, therefore stock selection. You said that you are fond of some of the banks. If you can be a little more specific as to what kind and what others.
So I'll tell you, specific stocks is aside because we can't talk about it here. But private banks, as I said, is what we like. One or two PSU banks. We continue to like. So what I think will happen is that as a result of the fact that your rates will come down, I think some of the interest rate sensitive will start getting pushed up again. So next 2 months will be tough for example, auto demand or even consumer demand, staples demand. But the fact is that as you go forward towards February and March, because banks have excess liquidity, incomes will grow because in rural areas and because of push, I think your auto demand will come back pretty strongly. Also because of lower rates. So autos will become a play again as a sector. I think
two-wheelers as well.
Two-wheelers will also, I'm sure, but the problem in two-wheelers is look at stock prices. I think there has been virtually no correction actually. So the fact is the immediate demand impact manifestation actually is higher on consumer staples names than on auto names. And two-wheeler stocks have corrected 6-7%. Demand is off 20%. While in staples stocks have corrected 20%, demand is off 5%. So you got to be mindful in terms of how you pick stocks here, because there is some certain amount of presumptions which has gone into the market as to how it has behaved. But I think consumption will come back. In fact, we have raised a number of stocks today in FMCG space to buy, because we have been waiting for valuations to get cheaper. Never did happen, but now that the stocks have come down, we have sort of raised the entire sector to a buy. Oil sector, OMCs continue to be sort of a play that we have liked, that continues. In fact, they become slightly cheaper because of oil. I think fundamentals there are still strong. Downstream gas plays we have continued to like, that continues.
Will money be made in mid-caps more?
Again, I think the challenge will be that what you have to see actually is that because these are highly leveraged companies in the sense that their operating leverage is very high. Small changes to demand, they find it very hard to manage. We have seen that in the past. Large caps weather slowdowns in the short term much better than mid caps. So I think we'll probably have a quarter or so where you have to wait for figuring out what's happening to earnings. Much easier to sort of make that call in large caps. And even that is tough now.
Yes.
Because every 10 days we are hearing a different story about demand, right? The changes in demand patterns within a month have been so rapid, and therefore so much uncertainty exists, that I would rather stick to large caps today than the mid caps.
Let me go far out then. I mean, I know that the near-term ambushes are there. In a one-year frame, what would you say, you know, the BSE 100 will return, or the Nifty 50, whichever you want to, or both?
So, I mean, if we don't have another shock like demonetization, because it's sort of, we're doing very nicely before that. We should have, hopefully we would have had GST sort of come through. Liquidity will be back. Hopefully rate cycle is such that it's pushing the growth upwards, which is what we expect. My expectation is we'll return about 12 to 13% in earnings, which was earlier about 16%. On that, you can sort of take a 5% expansion in multiple because rates have fallen. I think about 15, 17%, 17, 18% is something that you can.
Okay. Well, just hours ago, or maybe less than an hour ago, the Prime Minister appears to have hinted that the April 1 GST date may be difficult to maintain, but it is still a moving piece. I mean, if it's not April, maybe it's July. But on that issue, Sonal, what is the Nomura team factoring in terms of a fiscal stimulus, since the Reserve Bank quite unequivocally said that a dividend because of cancelled liabilities is not on the cards?
Yeah. So we are not penciling that in. So for us, the main fiscal boost essentially is coming through the income disclosure that's going to happen, plus the fact that this is a stick in terms of the need to be more tax compliant. And, you know, this benefit you will see over a period of time. When the GST kicks in, it'll, you know, feed in even further, but that's more like 2 years out. For the next 1 year, the main fiscal benefit, therefore, for us is the 50% tax that the government is going to impose on the income disclosure and the 25% additional deposit that they get. Specifically on the tax disclosure, therefore, our assessment is about 0.5% of GDP worth of additional fiscal gains can come in on account of this scheme.
Okay. All right. Finally, Neeraj, to end where we began, how many rate hikes are you all penciling in from the Fed? And therefore, you know, when does this anti-EM trade, according to you, end?
So I think the Fed rate hike cycle is still very benign in our opinion. You know, after this one hike that is scheduled for tomorrow, maybe another 2 hikes in the next year is something that our US strategy team is forecasting, economics team is forecasting. It still is pretty benign in that sense. So I don't think that there's a big anti-EM trade. It's just that the market was too much in one direction and this change happened and hence some readjustment happened in the market. I still feel that the environment in general is pretty slush with liquidity. It's still, you know, 2 big central banks are still generating more liquidity in the system. Fed is not really taking out liquidity, it's still holding its balance sheet, you know, pretty much there. So it's still reasonably positive for EM. You've got to have a good story like India's to be able to attract those flows. So I think that's where we sort of play out in terms of us versus the rest of the emerging markets.
That sums up the positivity of the Nomura team, that there is still a lot of liquidity sloshing around in the system, and that India would be the better growth story, and earnings growth therefore would quite easily make it to about just about 3 percentage points lower than the consensus, probably 12% even in the current year. On that positive note, thanks for watching this special edition of India according to the Nomura team.